Existing cross-border payments include settlement systems and participants that are subject to operating hours, cost structures, and transparency limitations. This creates friction in the payment experience, and while improvements have been made over time, there's still room to lessen the friction for our clients and others utilizing these payment systems. Tokenized cash, a category including stablecoins and tokenized deposits, seeks to streamline the payment experience by reducing settlement time, lessening costs, and integrating payments across jurisdictions. These improvements are most meaningful for long-tail corridors. These corridors have less access to global correspondent banks and therefore may include multiple banks in the transaction flow. That can increase cost, increase time, and increase operational complexity. These tokenized solutions seek to streamline the payment by creating a more direct path from the sender and the receiver. This also comes with increased transparency that benefits both parties. Traditional payment rails are still the most utilized and most dependent upon today, but we do see opportunities for stablecoins and tokenized deposits to play a meaningful role going forward. Today, thinking about stablecoins in particular, we're seeing Tether's USDT, Circle's USDC, and other stablecoins primarily utilized for cryptocurrency trading and for hedging local currencies in high inflationary jurisdictions. This is expected to have accounted for 95% of the transaction value in 2025. However, we're also seeing experimentation with traditional financial players, fintechs, and digitally native firms that have on-chain functionality integrated. These entities are largely using stablecoins for cross-border payments and for internal treasury flows. From a geographical perspective, we're seeing greater adoption in developing markets. In developed markets, such as the United States, we're seeing slower adoption as we await legislative and regulatory clarity and as we evaluate clear, meaningful improvements over the existing infrastructure that's in place. Globally, there is momentum in certain key jurisdictions, such as the EU, the UK, and Singapore, where legislation and regulation is clearer. When it comes to payments, faster is generally better. However, we see optionality as more critical for our clients. So there are other characteristics that our clients are considering, ranging from cost to payment certainty, liability framework, and the list goes on. We aim to give our clients the speed that suits their needs, but also the option to send payments other ways through other means that may meet other objectives that they may have. Stablecoins in particular offer increased speed, and there's still open questions around whether stablecoins can meet those other characteristics that treasurers and other corporate clients may need. We view large multinationals as most readily benefiting from adoption of stablecoins. This is especially the case for multinationals that are sending large cross-border payments or high-velocity payments. If these corporations also have advanced technology stacks, that will make them more readily available to see the benefits of stablecoins. We think regionals and other small players will likely enter the space and see the benefits as the infrastructure is more standardized and better integrated into their existing technologies and operational systems. Given that our client base spans this entire spectrum, we continue to evaluate how we can best meet the needs of those multinationals that may be higher demand in the near future, but also those regionals that may be evaluating a better integration into existing systems and infrastructures. Pre-funding is certainly a consideration for treasurers. However, it's not new. Pre-funding exists with existing payment methods and correspondent models today, so this is something that is part of the daily considerations of a treasurer. However, because of that, we are looking at other tokenized models to see if there are benefits that could be achieved without also introducing an increased pre-funding risk. So digital assets and stablecoins in particular do introduce a new set of risks and considerations for treasurers. So a few that I would highlight. First is conflicting legal frameworks across various jurisdictions. So this can make cross-border payments complex if you're sending and receiving in two different frameworks. Secondly, I think about the liability frameworks that may or may not be in place in those jurisdictions. So in the case of theft, or in the case of an errant transaction or dispute, there's an unclear liability framework. Think about reserve management. In some circumstances, the reserves behind a particular arrangement may make that arrangement more susceptible to depegging or may make the redemption risk of that particular stablecoin higher. And then I think about the treatment on balance sheet. So there are open questions for a treasurer around how stablecoins are treated on the balance sheet, how they're measured and recorded. For banks and other financial institutions, there are also new risks associated with stablecoins. In some jurisdictions, such as the United States, there are unclear regulatory frameworks, making it difficult to determine the role that a bank may or may not play. True adoption in this space is based on regulation, applications, and implementation. From a regulatory perspective, it's imperative that market participants understand what is permissible and what is required in order to make the ecosystem run efficiently and effectively. From an application perspective, we'll need to see real demonstrable benefits for our clients and for the other market participants. We'll need to see institutional grade applications and offerings that our clients can use and trust. And we will need to see integration with existing payment systems and existing market offerings that our clients utilize. From an implementation perspective, this will be an example of the network effect. As we see growing adoption among our clients and other market participants, we'll see accelerated growth in the space. However, without all three of these components coming together, we think the growth will be steady and modest. We view digital assets as playing a meaningful complementary role to the existing financial market. We expect to see regulatory clarity in the coming years, and we expect to see specific use cases and corridors where digital assets provide an advantage to our clients. The pace of evolution will depend on that regulatory clarity and adoption from our clients, but our mission at Bank of America is to ensure that we are prepared whenever our clients seek to utilize digital assets capabilities.
Bank of America. What would you like the power to do?